Hey everyone, welcome back to Corporate Decoder. Today, FTRK just filed a registration statement for a resale of shares, and I'm seeing some serious cash burn and a ticking clock. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is offering a lot of shares to sell, and it looks like they really need cash, but their financial situation is a bit shaky. So FTRK Group, ticker FT.R.K, is essentially letting some of their early investors sell their shares to the public. They are talking about selling up to 4.3 million shares. And here is the kicker. The company itself isn't getting any money from this. Their stock price as of early August was just 31 cents. That is really low, especially for a company whose shares are traded on NASDAQ. They are upfront about it. Investing here is risky. Looking at the structure of this filing, they cover a lot of ground from their business to risks, and importantly, their financial health. FTRK Group is basically an entertainment-focused event management company. They organize concerts and celebrity events. They also do artist endorsements. Their plan is to grow by expanding their operations locally and regionally, getting more access to venues, and building stronger partnerships. Now, let's dive into the risks. There are a lot of them. They depend heavily on their relationships with key agents, managers, and artists. If those relationships sour, their business could suffer. Losing key people is a big worry for them. If events get cancelled, it hurts their reputation and their bottom line. And get this, in 2026, two customers accounted for 85% and 15% of their revenue. That is a huge reliance on just a couple of clients. Losing one could be devastating. They also mention risks like natural disasters and diseases, which is pretty standard, but they had a direct hit from COVID-19, which caused significant disruptions. Then there are risks related to their stock. Since shares can be converted or exercised at different times, investors might end up paying very different prices, leading to some serious dilution for early buyers. They've also issued warrants which can put downward pressure on the stock price when exercised. This is a big one for any public company. They need to have strong internal controls to prevent fraud and ensure reliable financial reporting. Don't expect any dividends from this stock anytime soon. They plan to reinvest everything back into the business. This is a really critical risk right now. They've had issues with NASDAQ's minimum bid price requirement, and they've been given more time to fix it. But if they can't, their stock could be delisted. Think about what happened to companies like Radio Shack or Sears when they faced similar issues and eventually delisted. That is a rough road for any investor. Right now, they have about 22 million shares outstanding. The offering by selling shareholders could add another 4.3 million shares, which is a significant amount. Let's dig into the financials. Looking at the numbers for the years ending the 29th of February 2024, the 28th of February 2025, and the 28th of February 2026. Their revenue in 2024 was about 1.3 million Singapore dollars. Then it dropped to about 1 million in 2025, but jumped to over 2.1 million in 2026. That is a big jump in 2026, which is good, but it came after a dip. Their cost of revenue also went up, especially in 2026, but it didn't grow as fast as their revenue, which helped their profit. Gross profit in 2024 was around 265,000. It fell to about 128,000 in 2025, but then soared to over 826,000 in 2026. Their gross margin improved dramatically from 12.7% in 2025 to 38.5% in 26. That is a significant improvement. Here is where things get interesting. In 2026, their sales and marketing expenses shot up to over 4.6 million Singapore dollars. That is more than double their total revenue for that year. This is a huge spending increase, likely related to their IPO efforts and expansion plans. Because of that massive increase in sales and marketing costs, their operating loss in 2026 was a staggering 6.2 million Singapore dollars. That is way more than their revenue. And their net loss for 2026 was over 6.1 million Singapore dollars. They are losing a lot of money. Let's look at their balance sheet as of the 28th of February 2026. They had about 2.3 million Singapore dollars in cash. That sounds okay, but considering their massive losses, it might not last too long. Their accounts receivable, meaning money owed to them by customers, was zero in 2026. That is a bit strange and could be something to watch. They had about 1.7 million in current liabilities, which are debts due within a year. And their shareholders' equity was a positive 11 million Singapore dollars, which is good, but it is heavily influenced by all the money they raised from their IPO. On the income statement for the year, ending the 28th of February 2026, revenue was 2.1 million Singapore dollars. Cost of revenue was 1.3 million. Gross profit was 826,000, giving them a healthy 38.5% gross margin. That part looks good. But then look at sales and marketing expenses again, 4.6 million Singapore dollars. This massive spending is what drove their operating loss of 6.2 million and ultimately a net loss of over 6.1 million Singapore dollars. Their cash flow statement tells a similar story. In 2026, they used about 15.8 million Singapore dollars in cash from operations. That is a huge outflow. They also spent money on property and equipment, adding to their cash burn. The good news is they got a lot of cash from financing activities, over 18 million Singapore dollars, mostly from their IPO. This IPO money is why their cash balance at the end of 2026 was over 2.3 million Singapore dollars. Now, for some of the finer details in the notes. They are quite clear here. They have a net loss and significant cash used in operations, which raises substantial doubt about their ability to continue as a going concern. Management plans to raise more debt and equity, but there is no guarantee they will succeed. This is a major red flag. Similar to what we've seen with companies like Bed Bath and Beyond or Rite Aid, where financial distress can lead to a downward spiral. They recognize revenue when services are transferred to the client. For live entertainment, it is when the event happens. For their agency work, it is when the services are completed. They have outstanding warrants, which can be a bit tricky. In 2024, they had loans where warrants were issued. These warrants are a liability on their books until they expire or are exercised. They had a big IPO in May 2025, raising a significant amount of money. But since then, their stock price has fallen drastically. Their earnings per share is negative, showing they are losing money on a per share basis. In 2026, it was a loss of 28 cents per share. Interestingly, their companies in the Cayman Islands and British Virgin Islands don't pay income tax, which is common for offshore entities. The CEO, Lim Sin Fu Harris, owns a significant chunk of the company, over 51%. That gives him a lot of control. The CEO also made payments on behalf of the company, and the company owes him money. It is common, but it is something to keep an eye on. The selling shareholders are 3ILP and Z2 Capital. LLC 3ILP is listed as owning over 1 million shares and is looking to sell about 4.1 million. That is a lot of shares. The filing mentions a beneficial ownership limitation, meaning they can't own more than 4.99% of the company at any time. This suggests they might be strategically managing their stake. The selling shareholders will be selling the shares directly, likely through brokers. The expenses for this filing itself are estimated to be around $54,000. And finally, they list all the legal documents and agreements that back all of this up. Now, here is my take. FTRK Group is in a tough spot. They've got a growing business in a popular industry, event management, but they are burning cash at an alarming rate. That massive jump in sales and marketing expenses in 2026, while revenue grew, still resulted in huge losses. The fact that their stock is trading so low and they are facing potential delisting from Nasdaq is a serious concern. When a company is about to be delisted, it's a clear signal of distress. Think about what happened to companies like Radio Shack that couldn't meet listing requirements, and investors often see significant losses. The reliance on a few major customers and the large number of shares being offered by existing investors suggest they might be trying to cash out or raise funds in a difficult market. The going concern warning from their auditors is the biggest red flag of all. It means their ability to stay in business is uncertain. While they have plans to raise more money, there is no guarantee it will happen. My biggest concern here is the sustainability of their business model given the current burn rate and the risks associated with delisting. What I'm actually looking for is a clear path to profitability or a significant operational change that drastically cuts costs. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Make sure you like this video, comment below with your thoughts, and subscribe for more. Join our Discord community for more discussion, linked in the description.